everyone, this is Tejaswini, M.Com Final, MPM Government First Grade College Karkala, Mangalore University. Today I will explain about tax planning in case of conversion of a firm or sole proprietorship into company. Difference between partnership firm and company. The partnership firm is an organization which is formed with the two or more persons to run a business with a view to earn profit. Under partnership firm, we have partners and their liability is unlimited. A company is a type of business, but it is a legal entity formed by a group of individuals to engage in and operate a business. Under company, we have shareholders and their liability is limited to the extent of shares held by the shareholders. Conversion of a firm into company means partnership firm is going to transfer whole of its business to company. Here firm is succeeded by the company. The firm is no more exist now. The company is going to continue the business of the firm. When this conversion takes place, sometimes in view of expansion of the business, in case of expansion of the business, in case of multiple increase in turnover, in case of need for getting finances from the financial institutions or through public, it may be advisable to convert an existing business which is being carried out in the status of partnership firm into a company. What are the benefit of this conversion? There will be a limited liability to the shareholders after this conversion. Widening of capital base. Easy expansion and diversification is possible. Convenience in getting loan or finance from the banks or financial institution. One of the major benefit in view of tax planning in the case of conversion of a firm into company is there is no tax on capital gain. When the firm transfers its business to company, it is termed as succession or conversion. For example, on 31st 12 2019, firm transfers its business to company. Sale consideration is rupees 5 lakh. When firm transfers its assets and liabilities to the company, the sale consideration will be rupees 5 lakh. When we deduct the cost of acquisition from such sale consideration, the capital gain will be rupees 4 lakh. Here we are calculating this capital gain of the company but not of the firm. Actually, this is the capital gain of the firm, but here the firm is no more exists. The company is going to continue the business of the firm. That is why this capital gain is liable in the hands of a company. When we calculating capital gain, this cost of acquisition of the company shall be the cost of acquisition or cost of improvement of the firm itself. As I said, this capital gain is liable in the hands of company, but in the case of succession, if the succession is in accordance with the section 47 subsection 13, that means all the provisions of section 47 subsection 13 are complied with, then no capital gain tax is charged. That means the capital gain is exempted in the hands of company. Conversion of a firm into company. In order to claim exemption on capital gain, the conversion must fulfill for certain provisions which are laid down under section 47 subsection 30. Let's see what are those provisions. First, the provision is with related to assets and liabilities of the firm. All the assets and liabilities of the firm will become the assets and liabilities of the company immediately before succession. For example, if the succession date is on 31st 12 2019, before succession date, it will become the assets and liabilities of the company. Second condition with regard to partners. Under partnership firm, we have partners, but under company, we have shareholders. So all the partners of the firm immediately before succession becomes the shareholders of the company in the same proportion in their capital accounts stood in the books of the firm on the date of succession. Third condition is with related to consideration. The partners of the firm do not receive any consideration or benefit directly or indirectly in any form or manner other than by way of allotment of shares. See, when firm transfers assets and liabilities to the company, they can expect some consideration, but here consideration should be in the form of allotment of shares only. There should not be any other form of consideration. Fourth condition or provision with related to aggregate shareholding of the partners in the company. The aggregate of the shareholding in the company of the partners is not less than 50% of the total voting power in the company for at least 5 years from the date of succession. So, the aggregate shareholding should not be less than 50% of the voting power, and they should be as shareholder in that company for at least 5 years from the date of succession. Conversion of a sole proprietary concern into company. Sole proprietary concern means a concern which is owned by a single owner. Here he will going to transfer all his assets and liabilities, both tangible and intangible, to the company. The company is liable to pay tax on capital gain. Anyway, if the conversion is in accordance with section 47 subsection 14, the capital gain is exempted in the hands of company. Let's see what are those provisions. First provision is with related to assets and liabilities of the concern relating to the business immediately before succession becomes the assets and liabilities of the company. Second provision with related to the proprietor, he will become the shareholder of the company. Third provision with related to shareholding, the proprietor of the company of the concern, he will have the shareholding in the company is not less than 50% of the total voting power in the company for at least 5 years from the date of succession. The proprietor should have at least 50% of the total voting power, plus he should be as shareholder in that company for at least 5 years from the date of succession. Fourth condition is with regard to consideration. Here also there should not be any other form of consideration other than by way of allotment of shares. Next, set off and carry forward of losses and unabsorbed depreciation in case of conversion. Where a firm is succeeded by a company or a concern is succeeded by a company, if this conversion is in accordance with the section 47:13 and section 47:14, whatever the accumulated loss or unabsorbed depreciation was of the firm or concern, it can be deemed to be the loss or unabsorbed depreciation of the company. That means whatever the loss or unabsorbed depreciation was there of firm or concern, it can be treated as the loss or unabsorbed depreciation of the company, hence deduction is allowed accordingly. If only if the section 47:13 and section 47 are complied with. If those conditions or provisions are not complied with, then the set off of loss or provisions of depreciation made in any previous year in the hands of successor company shall be deemed to be the income of the company chargeable to tax in the year in which such conditions are not complied with. If those conditions are not complied with, then whatever the deductions have made, it will be treated as income of the company in the year in which such conditions are not complied with. Next, withdrawal of exemption, section 47A subsection 3. As I said, the capital gain actually liable to tax in the hands of a company, but in the case of conversion, if the conversion is in accordance with the section 47:13 in case of firm and section 47:14 in case of a concern, then the capital gain is exempted. That means the company need not liable to pay tax on capital gain. If those conditions are not complied with, then the amount of profits or gains arising from the transfer of such capital asset or intangible asset shall be deemed to be the profit or gains chargeable to tax of the successor company for the previous year in which the requirements of the provision to clause 13 and provision to clause 14 of the as the case may be are not complied with. So If the provisions are not complied with, then whatever the gain arises, it will be treated as the income of the company. Hence, the company is liable to pay tax on such income. Thank you. I hope you all understood this topic.